They say that 90% of millionaires were created through real estate, and real estate investing is one of the most popular categories in finance. But I don't think that you should invest in real estate if one of these three factors applies to you. So let's go ahead and quickly break it down. Now first, that stat was from Andrew Carnegie, billionaire Andrew Carnegie, from way back in the day. But in reality, that's actually not true. 90% of millionaires were not created through real estate. You can look at the Forbes list and run down the list and see how many people are actually investing in real estate. Not a lot of them. And if you go back and read the Millionaire Next Door, even the revised edition, you'll see that the vast majority of millionaires, about 1/3, were created through entrepreneurship, not just real estate. What does happen though is that millionaires tend to own real estate, and there is a difference. If I just happen to own it, it's different than it creating my millionaire status. And I'm not a millionaire yet, but I am close. I'm on my way. But let's go ahead and break it down. The first thing is liquidity. If you are somebody that needs liquidity or you prefer liquidity, real estate is not for you. What is liquidity? Liquidity is the ability to turn your asset into cash. So for example, I can sell a stock and have that money in my account within 3 to 4 business days tops. That's it. If I'm selling crypto, it's almost instant that I can get that money from point A to point B. I can't sell the back door of my house. I can't sell half the house or the kids' room or the playroom to get the cash that I need to do whatever it is I'm going to do. Real estate is notoriously illiquid. You cannot turn it into cash quickly. I mean, imagine how, or really just see how fast houses are selling now compared to where they were 2 years ago. Back then it was real quick. You could sell a house. Not so much anymore. And those things are constantly changing depending on your market, depending on what rates are, so on and so forth. But in general, real estate is not liquid. Now it brings us to number 2, because I know there's somebody watching saying, well, Kevin, what if I get a home equity line of credit, or I just have a line of credit based on the value of my property? I can take that loan and I can make that liquid and go invest it into other things. You could. Except that if you are someone who does not like leverage, that's something you want to be very careful of. What is leverage? Leverage is taking on debt to buy assets. And it works when you are owning a mortgage. But again, when you take on a mortgage, you take it on $200,000, $300,000, sometimes $400,000 in debt, which is fine if you plan on living there. But if you are someone who wants to own multiple properties, that's multiple mortgages and multiple figures of debt that you now have to contend with. Now, if you are fine with that and you've got people renting it out and paying those mortgages for you, you're good. You're good to go. You can go ahead and invest in real estate, but not everybody's equipped to do that or wants to take on that level of pressure, because depending on where you are and what the market is and what the job market is, if 2 or 3 people were to fall through and not pay those mortgages, that money now falls on you. That debt now falls on you, and you may have to sell the property or pay out 3 mortgages at once. Not everybody is equipped to do that, but some people are, which is why some people go for real estate and some don't. But that's the thing, especially when I was growing up and learning about money, I wanted to love the idea of having 5 properties. In the first month, I get 5 different rental paychecks and I can go do whatever it is that I want. And that's true if you own that many properties. The other half of that is if they don't, that is something you have to contend with. But also, it's going to require me to go into significant debt to even acquire those 5 properties to begin with. Now, there are ways around it. Perhaps I can get a group together. Also, if you are going to do this on your own, you have the right credit score and the right income for the bank to even approve you for these loans and mortgages to begin with. So those are the realities that you do have to contend with and know, because when you're watching this on social media, perhaps you're watching this on YouTube, they'll always tell you all the background stuff that you need to know. The third thing that you have to pay attention to, and the third thing that you shouldn't invest in real estate because of, is maintenance. If you don't have a significant sum of money to take care of any maintenance issues, real estate is not for you. Owning a home is not for you unless you have that money set aside. Now, in most cases, at least in my studies and research that I've done, I've even written articles on this too, anywhere between 1% to 3% of the home's value or the property's value should be saved for rental expenses. So for example, for me, I had a hole in my deck. I don't know where it came from, but it was a hole right in the middle of my deck that I had to pay $2,000 to get done and repainted. Now, that didn't bother me because, again, I had the money set aside specifically for stuff like that. But if you are investing in real estate and you don't have that there, that is going to be an issue for you. Now, if you got the cash set aside, or you have a group of people who have the cash set aside, then you're good to go. If you don't, then you want to reconsider investing in real estate, because it can get quite expensive depending on how many types of properties you own, where you are, and then what happens to those properties and how you take care of them, because that is an expense that is also something you should factor into your returns, which most people don't do. Especially when they're talking about their home, selling their own home. Let's say, hey, I bought it for this much, sold it for this much, but they don't factor in all the cost and maintenance that they really should subtract from that, because those were expenses, and that's really going to tell you how much you actually made. So you definitely want to make sure that you have the liquidity. You have to have the maintenance in cash, and you want to be careful of the leverage that you are taking on. All of that said, I still invest in real estate. Y'all know that I own my own home, and I also invest in something special that combines both real estate and the stock market. That is called a real estate investment trust, REIT, and I actually covered what they are and what are some of the best REITs out there, and that video is right here.